You know, when you sit down and look at the sheer volume of data we process every single day.
Oh, it's a massive stack.
Right. It's huge. You've got the Morningstar macro prints, the live blogged market tapes, the Zacks trading technicals, and you kind of expect them to act like a diagnostic x-ray, right?
Yeah, you want that clean binary image.
Exactly. You want to see a structural fracture in the credit markets. The x-ray shows the jagged line, the algorithmic trading models price it in, and the central banks point to it and say, well, there's the break, let's apply the cast.
It's a very comforting illusion, though. The idea that global financial architecture is just that legible.
It really is.
We want to believe that market microstructure and macroeconomic policy are perfectly synchronized. But they aren't.
No, they really are. And then you hit a day where the x-ray machine is just totally fundamentally broken. The imaging is contradictory.
The diagnostics are literally at war with each other.
And honestly, no day in recent memory illustrates that complete diagnostic failure quite like Thursday, March 19, 2026. So, welcome to the deep dive.
Glad to be here for this one. It's a heavy one.
It is. Today, we are not just skimming the headlines. We are taking this massive stack of contradictory sources we have, and we are going to reconstruct the anatomy of a day where a kinetic geopolitical shock, a stubbornly rigid Federal Reserve, and a series of wild corporate board-level maneuvers all just collided.
A perfect storm, really.
Yeah. Our mission today is to trace the exact mechanism step by agonizing step of how a missile strike halfway across the world transmits through the global financial plumbing to directly alter your mortgage rate duration, the wholesale cost of your groceries, and, the structural integrity of your retirement portfolio.
And I think it is absolutely vital to approach this not as a series of chaotic, disconnected events, but as a rigid chain of causality.
Right, because it looks chaotic on the surface.
Exactly. When you look at the raw feed, collapsing new home sales, spiking volatility indices, destroyed energy infrastructure, it looks like pure entropy.
Just noise.
But there's a very specific mechanical recalibration happening here. We are watching the real-time collision of kinetic regional conflict with a completely exhausted monetary policy framework.
Which is subsequently forcing a ruthless repricing of corporate equity valuations.
You nailed it.
It's a regime shift playing out in real time. And to map that shift, we're going to look at why the S&P 500 just violently broke its heartbeat line, its 200-day moving average.
A massive psychological blow.
Huge. We'll also look at why central bankers from Washington to Frankfurt are having a collective panic over second-round inflation effects, and perhaps most wildly, how a proposed SpaceX rule could forcefully rewrite the mechanics of passive indexing.
Forcing index funds to blindly buy up to $100 billion of stock.
It's insane. But to understand the market microstructure of Thursday, we really have to start at the absolute epicenter of the disruption.
Ground zero.
Ground zero, the kinetic catalyst. And that takes us to the Ras Laffan industrial complex in Qatar.
Which is right now the epicenter for the repricing of global risk.
Exactly. Let's look at the actual strike. Iranian missiles hit the Pearl GTL facility. Now, Pearl isn't just a random pipeline, right?
No, not at all.
It's a massive gas-to-liquids operation run in partnership with Shell. When the news broke on the Guardian Live blogs, you could immediately see the algorithms trying to price in the sheer scale of the physical damage.
Because the scale is essentially unprecedented in the modern liquefied natural gas market. We are not talking about a temporary supply chain bottleneck here.
Or like a shipping reroute around the Cape of Good Hope.
Right. The physical damage sustained at Ras Laffan wiped out 17% of Qatar Energy's total LNG export capacity.
17%.
In a matter of minutes.
Yeah.
And when you look at the statements from Qatar Energy CEO Saad Al-Kaabi, who, it's worth noting, specifically highlighted the unprecedented nature of this kind of kinetic strike from a neighboring state during Ramadan, he didn't sugarcoat the timeline at all.
No, he was pretty blunt.
He projected a 3 to 5 year window for full repair and capacity restoration.
A 3 to 5 year offline period for 17% of the world's most critical marginal supplier of LNG. I mean, that is a structural void in the market.
It completely breaks the forward curve for global energy pricing.
How so?
Well, think about the mechanics of the LNG market. It relies heavily on rigid 15 to 20-year offtake agreements.
Okay.
You have utility providers and sovereign energy ministries in places like Italy, Belgium, South Korea, and China who have baked these exact Qatari volumes into their baseline baseload power projections.
So they were counting on that gas showing up every single month.
Exactly. Now, you were looking at 5 years of potential force majeure declarations on those contracts. When 17% of Qatar's export capacity is just vaporized, those buyers are forced into the spot market to replace that volume.
And I'm guessing the spot market can't handle that.
No, the spot market simply does not have the depth to absorb that kind of panic buying without violent price discovery.
Which is exactly why the European market reacted like it had touched a live wire. I mean, UK and continental European month-ahead gas prices didn't just drift upward, they gapped up 15 to 25% instantly.
Instantly.
The UK gas contract spiked to 175 pence a therm in morning trading before settling slightly, and the continental European benchmark blew past 63 euros per megawatt hour.
And this is where the macroeconomic transmission mechanism begins.
Because it bleeds out.
Right, because those wholesale spikes do not stay contained within the commodity trading pits. They bleed directly into the industrial and consumer base.
And the data supports that. The Center for Economics and Business Research, the CEBR, immediately ran the downstream models on this price action. They are projecting that if these wholesale levels are sustained, standard UK consumer energy bills will blow past £2,100 a year.
Which is a devastating jump from the previous price cap of around $1,641.
It really is. It's massive.
It's a highly regressive tax on the consumer base. The CEBR is modeling that this energy shock alone could shave anywhere from 0.1 to 0.3 percentage points off of UK GDP growth.
Wow.
In an economy that is already flatlining, that is the difference between stagnation and a hard recession. It forces industrial curtailment.
Like factories shutting down.
Yeah. Heavy industry, chemical manufacturing, smelting, fertilizer production, they simply cannot operate profitably at 63 euros per megawatt hour. They have to shut down production lines.
And it wasn't just natural gas either. The crude oil complex traded with massive hypersensitive correlation. Brent crude, which is the global standard, spiked 10% on the initial headlines, touching $119 a barrel.
Which is the highest print we've seen in nearly 4 years.
Right, before finding some equilibrium around 108. And I'm looking at the geopolitical tape from Thursday, and the posturing was intense.
If moving incredibly fast.
Yeah. You have the Trump administration issuing a very specific threat to massively blow up the South Pars gas field, which Iran and Qatar share, if there's any further escalation. You have Israeli Prime Minister Netanyahu reportedly holding off on direct strikes to the Iranian gas infrastructure, specifically at the U.S. administration's request.
Right.
And simultaneously, you have this rapid response coalition of 6 nations, the UK, France, Germany, Italy, the Netherlands, and Japan, pledging naval assets to secure the Strait of Hormuz.
And when you look at those geopolitical variables purely through the lens of market mechanics, what you are seeing is the rapid imposition of a massive security premium on the entire global energy complex.
A security premium, so just pricing in fear.
Exactly. The market is suddenly forced to transition from pricing in standard supply-demand fundamentals to pricing in tail risk scenarios of total infrastructure annihilation. The formation of the naval coalition to secure the Strait of Hormuz is particularly telling.
Because of the volume that goes through there.
Yes. Roughly 20% of global oil consumption passes through that specific maritime choke point.
But here is where the X-ray machine really starts showing a fractured picture. Because while Brent crude is exploding to $119 and pricing in this massive geopolitical premium, West Texas Intermediate WTI, the U.S. domestic benchmark, it barely flinched.
It was remarkably insulated.
Yeah. It only rose 1.7% to settle around $97.95. That spread between Brent and WTI blew out to an 11-year high.
It's a huge disconnect.
To me, this looks like the difference between a global maritime choke point getting blocked versus like a closed domestic rail network that is functioning perfectly fine. The arbitrage between the two markets is completely physically constrained.
That is precisely the correct framework. Think of Brent and WTI like 2 local gas stations. One gets cut off by a sinkhole and prices skyrocket, while the other is sitting on a massive local reserve. The U.S. shale complex and localized storage infrastructure insulate the domestic market from the immediate kinetic shock, provided the export capacity doesn't instantly drain the domestic supply.
Right.
But that massive blowout in the Brent-WTI spread is exactly why Stephen Innes, the asset manager we were reading in the Morningstar notes, called this dynamic a regional wrecking ball.
Because it's not just the outright price of the oil, it's the currency you are using to buy it.
Exactly. This is where the dollar smile theory and energy markets collide to crush emerging markets and European industrials. Oil is a dollar-denominated asset. In a geopolitical crisis, global capital violently rotates into the U.S. dollar as a safe haven.
Driving the value of the dollar up against the euro, the yen, the pound.
Precisely.
So if you are a factory operator in Germany or Japan, you're getting hit with a double whammy. The outright price of the Brent crude you need has spiked 10%. But your local currency has also lost purchasing power against the dollar.
It compounds exponentially.
Right, so your real localized cost of energy is just devastating.
It creates a sovereign balance of payments crisis.
Yeah.
As the natives pointed out, if this kinetic escalation in the Middle East sustains itself, we are no longer dealing with a standard commodity cycle. We move into enforced behavioral change and structural demand destruction.
Meaning people just have to stop buying it.
Yes. The market has to ration demand through prohibitive pricing. And for you, the listener, this means inflation stops being a temporary cyclical blip and becomes deeply embedded into the cost of every single physical good that requires transportation or manufacturing.
It's a regime shift.
It's a fundamental regime shift in the global cost of capital.
Which perfectly maps to the absolute paralysis we saw within the walls of the Federal Reserve on Thursday. This energy shock hit right as the central banks were trying to navigate an incredibly delicate soft landing.
And it completely derailed them.
Completely. If we look at the Morningstar macro analyses of the Fed's latest move, they executed what the street is calling a hawkish hold.
And to fully grasp the violence of that pivot, we really have to look at the trajectory we were on. Going into 2026, the broad market consensus, the baseline assumption of almost every major institutional portfolio, was a steady, predictable path of rate cuts.
Right, because the Fed had already shaved 1.75 percentage points off the terminal rate between September 2024 and December 2025.
The market had priced in a glide path back to a neutral rate.
But then right in the shadow of this Middle East strike, the Fed locks the target range at 3.50% to 3.75%. And it wasn't just the fact that they held right. It was the forward guidance that absolutely shattered the bond market.
The updated dot plot was a bloodbath for dovish sentiment.
It really was. Break that down for us.
The dot plot repricing is historic. The median projection from the committee evaporated from multiple anticipated cuts down to just a single 25 basis point cut for the entirety of 2026.
Just one cut.
Just one. And the Fed funds futures market, where institutional capital is actually hedging this risk, immediately priced in a 48% to 73% probability, depending on the specific CME contract duration, of 0 rate cuts this year. None.
The capitulation was universal. Look at Stephen Mirren.
Oh, that was a huge tell.
Right. He's widely considered one of the most dovish voices on the board. He's someone who analysts previously modeled as pushing for up to 6 cuts this year, basically to help stimulate the administration's broader economic goals. Even he capitulated. He slashed his projection to 4.
Yeah, the final committee vote to hold was 11-1.
That kind of unanimous hawkishness tells me they are looking at pipeline inflation data that absolutely terrifies them.
And the data justifies the terror. The internal models are flashing red. Overall, PCE personal consumption expenditures, which is the Fed's preferred gauge, is now projected to accelerate to 3.5% year-over-year by April. We haven't seen prints like that since the sticky inflation peaks of mid-2023. Core PCE was revised upward to 2.7%. But the real leading indicator, the one that guarantees this inflation is going to bleed into the consumer level, was the February Producer Price Index.
The PPI.
Yes, the PPI jumped 0.7%, blowing past the 0.4% consensus estimate.
And the PPI is the canary in the coal mine for corporate margins, right? If producers are paying more, it's only a matter of time before they pass it on to us.
Exactly.
And the macro sources point very clearly to 2 primary drivers for that wholesale spike. First, the energy shock we just discussed. And second, the recent imposition of the Liberation Day tariffs on U.S. imports.
Both are massive factors.
Right. From a pure supply chain mechanics perspective, a tariff is an immediate, frictionless input cost increase for domestic producers who rely on foreign intermediate goods.
Correct. Whether it's energy bottlenecks or tariff implementations, the result is an aggregate supply shock. It shifts the entire supply curve to the left. And this is why we saw immediate, synchronized contagion across the global central banking apparatus.
It wasn't just the Fed panicking.
Not at all. The Bank of England voted to hold at 3.75%, explicitly citing the new shock to the economy originating in the Middle East. The European Central Bank, the Swedish Riksbank, and the Swiss National Bank all abruptly halted their rate-cutting cycles.
Just a collective freeze.
The ECB was even forced to revise its 2026 inflation forecast up from 1.9% to 2.6%.
They are all staring down the exact same barrel, but what specifically are they so afraid of? Why risk throwing the global economy into a recession to fight an inflation spike that is clearly driven by external kinetic supply shocks rather than, overstimulated consumer demand?
Because of the latency of second-round effects.
Okay, what does that mean?
The first-round effect is simply the spot price of LNG, or crude oil spiking. Central banks generally look through first-round effects because monetary policy can't drill more oil or fix a blown-up gas facility.
Right, Jerome Powell can't build a pipeline.
Exactly. But a second-round effect is when that prolonged energy inflation bleeds into baseline inflation expectations. If the cost of living remains elevated for 12 to 18 months, organized labor and salaried workers begin demanding commensurate wage increases to maintain their real purchasing power.
And when wages go up, corporate payroll costs explode.
Yes.
Which forces companies to raise the end prices of their goods even higher to defend their margins.
Which then triggers another round of wage demands. It's the classic 1970s wage price spiral.
It's a terrifying loop.
Once a wage price spiral becomes entrenched in the labor psychology, it is nearly impossible to break without inducing a severe, prolonged recession. The central banks are holding rates at 3.75% and beyond to deliberately suppress aggregate demand. They are hoping to introduce enough slack into the economy to break the pricing power of both labor and corporations before that spiral can take root.
But this is where the macroeconomic data gets incredibly paradoxical. If the Fed is actively trying to suppress demand and introduce slack into the system, why did initial jobless claims just drop to 213,000?
It's a massive contradiction.
That beat forecasts. The labor market is refusing to crack. People are still getting hired, they are still collecting paychecks, and they are still spending.
It's the defining structural paradox of this economic cycle. The transmission mechanism of monetary policy is entirely broken, resulting in a bifurcated dual-track economy. You have the wage-earning economy, which remains incredibly tight and resilient.
So regular people working jobs.
Exactly. Demographics, labor hoarding post-2020, and the shift toward service sector employment have insulated the everyday wage earner from the interest rate shock. They have cash flow, so consumer spending metrics remain buoyant.
But then you look at the other side of the economy, the asset-buying economy, and it looks like a depression.
Precisely. Any sector that requires leverage, duration, or heavy capital expenditure is suffocating. Look at the housing data that dropped alongside the Fed decision. January new home sales collapsed by 17.6% to an annualized rate of 587,000 units.
That is a catastrophic contraction.
It is.
Because mortgage rates are tethered to the 10-year Treasury yield, which was hovering aggressively at 4.26%. If you are a wage earner, your paycheck is fine, but the moment you try to convert that paycheck into a leveraged asset like a home, the cost of capital mathematically locks you out of the market.
So the Fed is trapped. The resilient labor market keeps services inflation sticky, which prevents them from cutting rates, which in turn perpetually crushes the capital-intensive sectors of the economy. They are using a blunt instrument to fight a localized fire, and they are burning down the housing market in the process.
Wow. Which brings us perfectly to how this massive, unresolved macro tension finally snapped the market microstructure on Thursday. Because when you combine a massive geopolitical energy shock with a Federal Reserve that has explicitly taken rate cuts off the table, the algorithmic trading model simply cannot maintain current equity evaluations.
The mathematics of the equity risk premium break down completely.
Right. And we saw that structural breakdown manifest in the indices.
Yeah.
The Dow closed down to 46,021, which is its lowest point of the year. But the critical fracture was in the S&P 500.
The heart monitor flatlined.
It closed at 6,606. Now, the point drop wasn't the headline. The headline, the thing that triggered the red alerts on every Bloomberg terminal, was the S&P 500 slicing cleanly below its 200-day moving average for the first time in almost a year.
And we really cannot overstate the mechanical severity of that breach. The 200-day moving average is not just a line on a chart.
No, it's a boundary.
It is the fundamental dividing line between a structural bull regime and a bear regime for institutional capital. When an index trades above it, trend-following models, CTAs, commodity trading advisors, and risk parity funds are mathematically mandated to maintain long exposure. The liquidity is deep, and the bid is consistent.
But the moment it breaks below that line, the liquidity paradigm flips.
Instantly, it triggers cascading automated sell programs. Institutional risk models interpret the breach as a failure of momentum, forcing portfolio managers to dynamically hedge their downside or liquidate beta exposure.
The natural buyers just step away.
The natural buyers step away from the order book, dark pool liquidity evaporates, and you get these vicious, unanchored air pockets in price discovery.
And you could see that panic clearly reflected in the derivatives market. The VIX, the implied volatility index, the fear gauge surged 12.2% to close at 25.09.
That's a huge jump.
Yeah, a VIX over 25 means institutions are aggressively bidding up the price of put options. They're willing to pay exorbitant premiums just to buy fire insurance on their portfolios. But what fascinates me is where that terrified capital actually flowed.
It didn't go where you'd expect.
Exactly. It didn't go to the historical safe haven. Gold actually dropped 3.5% during this massive geopolitical and market panic, falling to around $4,650 an ounce. My deduction here is that this is entirely a story about real yields and opportunity costs.
Your deduction is absolutely correct. Gold is a non-yielding asset. It pays no dividend. It offers no coupon. Its primary function is to serve as a hedge against currency debasement and deeply negative real interest rates.
Right.
But when you have a hawkish Federal Reserve holding the line, and you have the 10-year Treasury yielding 4.26%, the institutional calculus changes.
Because if I'm a portfolio manager, I can either hold a brick of gold that yields nothing and costs money to store, or I can park my capital in a risk-free U.S. Treasury and clip a guaranteed 4.26% coupon while I wait for the volatility to subside.
Exactly. When nominal yields stay higher for longer and inflation is relatively bounded compared to the 1970s, real yields, the yield adjusted for inflation, remain highly attractive. The opportunity cost of holding zero-yield gold becomes mathematically prohibitive for large institutional mandates, so they dump the gold and buy the duration.
Even with this aggressive algorithmic selling and the VIX spiking, I was reading the sell-side notes, and some of these massive investment banks are still violently bullish.
Yeah, the UBS note.
Yeah, UBS reiterated their year-end target for the S&P 500 at 7,700. That implies a 14% rally from where we broke down. Are they just huffing hopium? Because looking at a broken 200-day moving average, a Middle East war, and a hawkish Fed, a 14% rally seems structurally impossible.
It requires a very specific, longer-term fundamental thesis. UBS isn't ignoring the macro headwinds. They are interpreting the current drawdown not as the onset of an earnings recession, but as a necessary valuation multiple compression.
Okay.
They are stripping out the macro noise and looking at corporate balance sheets. Their model relies heavily on two pillars. First, that aggregate S&P 500 earnings per share will still grow by 11% this year, largely driven by cost-cutting and margin defense.
And the second pillar?
And second, that the hundreds of billions of dollars currently being poured into artificial intelligence infrastructure will begin translating into tangible cross-sector productivity gains by the third or fourth quarter.
So they are basically betting that technology will essentially outgrow the interest rate drag. But while the S&P 500 megacaps were dragging the broader index down, there's this incredible anomaly in the tape. The Russell 2000, which tracks small-cap companies, actually closed up 0.6%. You have a global energy shock, a strong dollar, and crashing megacaps, yet the smallest, most theoretically vulnerable companies catch a bid. This has to be a currency and supply chain isolation play.
It is the ultimate expression of domestic isolationism in the equity markets. S&P 500 megacaps are heavily reliant on global supply chains and foreign revenue streams.
Right, Apple, Microsoft, they sell everywhere.
Exactly. When the U.S. dollar appreciates aggressively, as it does during a geopolitical flight to safety, every single euro, yen, or pound that Apple or Microsoft earns overseas is worth less when translated back into dollars on their quarterly earnings reports. It's an automatic mechanical haircut to their bottom line.
But a small-cap industrial supplier in Ohio or a regional service provider in Texas doesn't care about the euro-dollar exchange rate.
Exactly. The constituents of the Russell 2000 generate the vast majority of their revenue domestically. They are far less exposed to transoceanic shipping disruptions, Middle Eastern kinetic volatility, or currency translation headwinds.
It's basically a sanctuary trade.
Yes. In an environment where the global macro picture is toxic, capital rotates down the market cap spectrum to find companies whose balance sheets are insulated by the borders of the U.S. economy.
Okay, speaking of market caps and index funds, we have to talk about the absolute bombshell that dropped behind the scenes on Thursday, the proposed SpaceX rule.
That was wild.
When I read the Zacks report on this, I had to read it 3 times because it sounds like something that breaks the fundamental philosophy of passive investing.
It is a structural earthquake for market mechanics. It completely subverts the established cadence of capital formation.
So, S&P Dow Jones Indices is reportedly in deep discussions to waive their standard inclusion rules, specifically the rigid requirements that a company must demonstrate a 12-month track record of GAAP profitability and a seasoned public listing history.
Which are core tenets of the index.
Right. And they want to waive them in order to fast-track SpaceX into the S&P 500 immediately following its IPO.
To understand the violence this would inflict on the market, you have to look at the sheer mathematics of SpaceX's valuation. We are talking about an estimated IPO valuation hovering around $1.75 trillion.
It is massive.
In the history of public markets, we have never seen an asset of that size transition from private to public overnight.
And because of the rise of passive investing, the S&P 500 isn't just a list of companies anymore, it's an automated buying machine.
Exactly. Trillions of dollars in 401ks, pension funds, and sovereign wealth mandates are tethered blindly to the S&P 500 index. If S&P Dow Jones bends the rules and forces a $1.75 trillion company into the index on day one, every single passive fund manager is mathematically obligated to replicate that weight in their portfolio instantly.
Well, they don't have a choice.
None. They cannot wait for price discovery. They cannot analyze the fundamentals. They must buy the stock at whatever price the market makers demand.
The estimates I'm seeing suggest this immediate inclusion would trigger between $80 billion and $100 billion of forced price-agnostic buying from passive funds.
It is a profound distortion of market microstructure. When $100 billion of inelastic demand hits a newly public float, it creates a massive liquidity vacuum.
So active managers are just going to game it.
Of course, institutional active managers will inevitably try to front-run the inclusion, buying up the float and holding the index funds hostage at exorbitant premiums.
But the broader philosophical question is terrifying. If S&P Dow Jones is willing to rewrite the rules just to capture a systemically massive, hype-driven private monopoly, what does that make the S&P 500? It used to be a broad, diversified barometer of the U.S. economy.
A reflection of the market.
Right. But if this goes through, it feels like passive investing just becomes an aggressively concentrated bet on a handful of mega founders. You are stripping the passive nature out of it and replacing it with automated momentum trading on idiosyncratic single company risk.
It forces us to question the entire premise of modern portfolio theory. If you are buying the S&P 500, you are no longer buying a diversified basket of cash flows. You are buying a concentrated, rule-altered vehicle that is highly susceptible to single-point failures, whether that's a semiconductor fab delay, a regulatory antitrust suit, or a rocket exploding on a launch pad.
Wow.
It introduces profound idiosyncratic risk into what is supposed to be the ultimate safe, diversified asset class.
Which is the perfect transition into the actual corporate boardrooms. Because while the macro environment was detonating, specific companies were fighting for their lives on Thursday. Let's look at the micro responses to this macro chaos, specifically how different sectors are managing this brutal cost of capital.
It was a very telling earnings day.
Yeah, I want to start with the tech sector and the massive divergence we saw between Micron Technology and Rivian. Micron reported an absolute blowout earnings beat. Their top and bottom lines crushed the consensus estimates due to the insatiable demand for memory chips to power AI data centers.
They crushed it.
And yet, the stock was punished, dropping 3.8%. My read on this is that the market is finally suffering from CapEx cycle exhaustion.
That is an incredibly astute read. The market is developing a severe bifurcation between what we can call software AI and physical AI.
Tell me more about that.
Micron represents the pure infrastructure play, the picks and shovels of the generative AI boom. But building that infrastructure requires staggering capital expenditure. Micron has to continually build next-generation fabrication plants to produce high-bandwidth memory, and those fabs cost tens of billions of dollars and take years to come online.
And investors are looking at that CapEx spend, looking at the 4.26% 10-year treasury, and realizing that the cost of financing these massive infrastructure builds is skyrocketing.
Exactly.
While the actual revenue generated by the end-user AI software hasn't caught up, it's the ultimate duration mismatch.
It's the classic infrastructure latency problem. The market is terrified that the hyperscalers, the Microsofts and Googles buying Micron's chips, are building a multi-trillion-dollar highway system for autonomous vehicles that don't exist yet.
Right.
And compounding this anxiety was a very specific warning issued by the World Trade Organization on Thursday. The WTO explicitly flagged that sustained high oil and natural gas prices could act as a hard constraint, literally crimping the AI boom.
Because AI data centers are functionally just massive energy arbitrage machines. They require gigawatts of continuous baseload power to run the GPUs and cool the server racks.
Massive amounts of energy.
If the Qatari LNG shock drives baseline electricity costs into the stratosphere, the operating margins of these AI models completely collapse. The physical reality of the energy market is colliding with the hypothetical margins of software.
Precisely. Software is ultimately tethered to the physical grid. But while Micron was punished for its long-duration capex, Rivian, an electric vehicle manufacturer that has historically struggled with profitability, saw its stock jump 3.8% on a day when the broader market was bleeding.
And that was driven entirely by Uber stepping in and announcing a $1.25 billion strategic investment to purchase 10,000 autonomous robotaxis from Rivian.
A massive deal.
So the market hates Micron's physical infrastructure build-out, but it vigorously rewards Rivian's physical AI. Why the divergence?
Because of the timeline to margin expansion. Uber's investment in Rivian is a direct near-term assault on their largest operational expense.
Which is human labor.
Yes. In an economy plagued by sticky wage inflation and tight labor markets, a robo-taxi fleet offers a concrete, easily modeled path to labor displacement. Physical automation provides an immediate, tangible boost to operating leverage.
It's measurable right now.
Exactly. The market isn't waiting 5 years for a hypothetical generative AI model to figure out how to monetize. They can model the exact cost savings of removing 10,000 human drivers from the Uber network tomorrow. Labor displacement is the ultimate margin expander in a stagflationary environment.
Operational efficiency over speculative growth. And if we want to talk about operational efficiency, we have to look at FedEx.
Oh, FedEx was a standout.
They reported on Thursday and completely shattered their EPS estimates. They posted $5.25 per share against an analyst estimate of $4.15. In a macroeconomic environment where global trade volumes are stalling, the Red Sea is a kinetic zone, and fuel costs are spiking, printing a 26% EPS beat is almost mathematically absurd. How are they pulling that lever?
Through aggressive, ruthless corporate restructuring. CEO Raj Subramaniam has fundamentally rewired the operational cadence of the company through their Drives transformation program. Yes, they aren't relying on top-line revenue growth. They are actively defending their margins through disciplined capacity management, consolidating their flight networks, and stripping out redundant structural costs.
But the real driver of shareholder value here isn't just flying fewer empty planes. It's the structural financial engineering. They confirmed they are moving forward with spinning off FedEx Freight in June 2026.
Which is the classic playbook for unlocking trapped equity in a high-cost capital environment. FedEx Freight is a highly profitable, less-than-truckload business trapped inside a massive, capital-intensive global logistics conglomerate.
Right, it's getting weighed down.
Exactly. By spinning it off into a pure-play, publicly traded entity, they eliminate the conglomerate discount. The market is willing to assign a much higher valuation multiple to a focused freight business than it is to a sprawling, complex global network. It allows FedEx to return capital to shareholders while creating a leaner, more agile core business.
It's a survival tactic. You shed the weight to maintain altitude. And we saw a very different kind of survival tactic in the retail sector with Five Below.
They had a great day.
They were one of the undisputed winners of the day, with the stock surging over 10% after posting a 15.4% increase in comparable store sales. I look at this and think about the bifurcated economy we discussed earlier. If the middle-class asset buyer is suffocating under 7% mortgages and spiking energy bills, they have to trade down.
And Five Below has perfectly calibrated their merchandising strategy to capture that exact demographic shift. The phenomenon is known as the elasticity of demand in the discount tier.
Okay.
As discretionary income shrinks, consumers abandon premium retailers, but they don't abandon the psychological desire to consume. They transition to value-oriented formats that offer what the industry calls the treasure hunt experience.
They want the dopamine hit of a discretionary purchase without the catastrophic credit card bill.
Exactly. And Five Below's genius is their Five Beyond strategy. They recognize that rigidly anchoring themselves to a $5 price point in an inflationary environment would eventually crush their gross margins.
Right, because their costs are going up too.
Yes. So they slowly, methodically introduced higher price points, $6, $8, $10, while maintaining the overarching brand perception of deep value. Furthermore, their operational execution is stellar.
How so?
They successfully absorbed the input cost shocks of the Liberation Day tariffs by leveraging the fixed costs of their massive sales volumes and aggressively reducing shrink, which is retail parlance for inventory loss due to theft or operational error. They are defending their margins while simultaneously capturing the traded-down consumer.
So you have FedEx spinning off assets to survive and Five Below leveraging price elasticity. But what happens when companies try to survive the old-fashioned way by just buying their competitors?
It was an absolute graveyard for mega M&A.
Thursday was brutal for M&A. The cost of capital and the geopolitical uncertainty just murdered the concept of the mega deal.
Consolidation is incredibly difficult when the debt markets are constrained and antitrust scrutiny is elevated. The risk premium assigned to integration is simply too high.
Look at the asset management sector. Annis Henderson firmly rejected a $9.1 billion hostile takeover bid from Victory Capital. And what makes this so fascinating is that Victory was offering a massive 16 to 18% premium over a competing, friendlier bid from Trian Fund Management and General Catalyst. In what universe does a fiduciary board reject an 18% higher price tag?
In a universe where assets under management AUM are highly elastic and sensitive to operational instability.
Oh, okay.
In the asset management space, your inventory goes down the elevator every night. The Janus board looked at the hostile nature of the Victory bid and correctly calculated the integration risk. A hostile takeover inevitably triggers internal culture wars, portfolio manager defections, and severe technological integration bottlenecks.
And when the portfolio managers leave, the institutional clients follow them out the door.
Precisely. Janus explicitly noted the preferences of their major banking distribution partners, like Citigroup and Morgan Stanley. Those institutional allocators prioritize platform stability over everything else.
They don't like chaos.
Not at all. If they sense operational chaos from a hostile merger, they will simply redeem their clients' capital and allocate it elsewhere. The Janus board realized that an 18% upfront premium is meaningless if 30% of your AUM flees during the chaotic integration process. They prioritize the strategic fit and stability of the Trian deal because it preserves the core value of the business.
We saw similar friction in Europe, with UniCredit launching a hostile exchange offer to force Commerzbank to the negotiating table, which the Commerzbank CEO is fighting tooth and nail.
M&A is just frozen.
But the most spectacular M&A collapse of the day wasn't in banking. It was in the grocery aisle. The rumored condiment mega merger between Unilever and Kraft Heinz completely imploded. And reading through the sources, this isn't just two boards disagreeing on price. This signals a deep existential crisis across the entire big food ecosystem.
The legacy consumer packaged goods model is undergoing a structural collapse. For decades, the big food playbook was simple. Leverage massive brand equity, command premium shelf space, and rely on steady, demographic-driven volume growth for heavily processed, high-margin items.
And that engine is dead.
That engine is dead.
Why? Is it just input inflation?
Inflation is the catalyst, but the root cause is a fundamental shift in consumer behavior, accelerated by pharmacology.
Ah, the drugs.
Yes, the explosion of GLP-1 receptor agonists, the new class of weight loss drugs, is literally altering the chemical pathways of consumption on a mass scale. These drugs delay gastric emptying and suppress appetite at the neurological level. They are effectively shrinking the total addressable market for caloric intake.
So you have tens of millions of consumers who physically no longer possess the desire to consume the high-calorie, highly processed foods that companies like Kraft Heinz and Unilever rely on for their core margins.
Exactly. When volume growth structurally, permanently declines, combining two massive, struggling legacy portfolios doesn't solve the underlying problem. It just creates a larger, slower, more debt-laden entity, facing the exact same demographic headwinds. You cannot financial engineer your way out of a permanently shrinking consumer stomach.
Which is why Unilever is reportedly abandoning the merger strategy entirely and pivoting to the FedEx playbook. They are actively moving forward with plans to completely spin off their food business, following the exact blueprint they used when they demerged their Magnum ice cream unit.
It's the only way forward for them.
They're amputating the structurally declining assets to protect the valuation multiple of their personal care and beauty divisions.
It is the defining corporate strategy of the era. The conglomerate model is dead. Spin-offs, agility, and pure play margin defense are the only ways to command a premium in a market starved for genuine growth.
So let's pull all these threads together. Let's synthesize the X-ray we've been looking at. When you look at the kinetic strike in Qatar, the hawkish paralysis of the Fed, the breakdown of the S&P 200-day moving average, and these desperate corporate maneuvers Thursday, March 19th, 2026, wasn't just a bad day in the market.
No, it was much more than that.
We are witnessing a fundamental, irreversible rebaselining of the global economic operating system.
That is the essential takeaway for anyone allocating capital today. The defining characteristics of the 2010s zero interest rate policy, hyper-optimized, frictionless global supply chains, and infinite duration growth at any price have been permanently dismantled.
They're gone.
We have transitioned into a grueling era defined by resilience and yield. Capital will only reward domestic isolation, immediate operational efficiency, and bulletproof balance sheets.
Because the geopolitical variables have permanently altered the risk premium, we are living in a world where critical energy infrastructure is actively targeted, forcing an embedded inflation floor that central banks are powerless to fight without crushing the asset markets.
Which means the reflexive buy-the-dip mentality that conditioned a generation of investors is effectively obsolete.
It's a hard habit to break, though.
It is, but when the S&P 500 cleanly slices through its historical 200-day moving average, it is a mathematical signal that the central bank's safety net has been withdrawn.
Yeah.
The liquidity isn't coming to save you. You have to adapt to a landscape where the cost of capital is punitive and structural growth is incredibly rare.
It's a completely different rule book. And speaking of rewriting the rules, I want to leave you, the listener, with one final, deeply unsettling thought to chew on.
Oh, this is the big one.
Yeah. We explored how S&P Dow Jones is actively considering waiving their historical profitability and listing rules to forcefully parachute SpaceX's $1.75 trillion valuation directly into the S&P 500, triggering up to $100 billion in blind, mandated buying from passive index funds.
The ultimate distortion of price discovery.
Exactly. But take that a step further. If the arbiters of the index are willing to suspend their own structural integrity to capture the hype of a massive private monopoly, does the S&P 500 cease to function as a diversified barometer of the broader U.S. economy?
That is the question.
Does it instead mutate into a highly concentrated, mandated bet on the idiosyncratic risks of a handful of mega founders? If the automated, quote-unquote, safe core of your retirement portfolio can be entirely derailed by a single rocket launch failure or a single missile hitting a gas facility on the other side of the planet, is passive investing actually passive anymore?
It forces a profound reevaluation of what we actually own when we think we own the market.
It really does. Or have we just systematically automated our exposure to the most violent, unpredictable elements of a fractured new economy? Think about that diagnostic X-ray machine we talked about at the top of the deep dive. We spent decades trusting index funds and macroeconomic models to give us a clean, objective picture of our financial health. But when the rulemakers are actively doctoring the imaging on the fly and the underlying data is being violently skewed by regional kinetic wrecking balls and trapped central bankers, the machine isn't just malfunctioning, it's showing us an entirely different patient. Thank you for joining us on this deep dive. Take a hard look at your assumptions, keep questioning the consensus, and we will see you next time.